Welcome to the WealthKode Blockchain Knowledge Series, and in this episode we'll be talking about stablecoins. And although CBDCs will be of interest in this topic, we'll save the discussion on CBDCs for a standalone video in a future episode. No hype, no BS, just laying out the facts for your reference so you gain a greater understanding in under 15 minutes. Remember to follow and subscribe to our pages for all future episodes being released on a regular basis. And share this video with friends, family, and the online community to help them better understand this new asset class. And of course, if you'd like us to delve deeper into any of your favourite blockchains, cryptos, or digital assets for future episodes, or you have any questions, feel free to drop a comment. So let's get started. For crypto investors hunting short or long-term gains, stablecoins must seem like a mystery. Why would anyone buy digital assets that, as a virtue, are supposed to remain stuck at a fixed price? And why have stablecoins become so popular so quickly? There must be a good answer to these questions, since at one point in 2020 there was only $6 billion worth of stablecoins in circulation. By mid-2021, that figure stands at $115 billion, accounting for around 8 to 9% of the entire crypto market. Stablecoins are kind of a big deal these days. If we look at the top 10 cryptocurrencies ranked by market cap at the time of this recording, we'll find Bitcoin at the top with a current price of around 30k, Ethereum in second place with a current price of around 2k, and a stablecoin, Tether, ranked third with a price that is theoretically always $1. If we look at the rankings for 24-hour volume, that is the amount of buy and sell orders placed in a day, Tether ranks first. What's more, an asset that does not change in value, an asset that is always supposed to be worth $1, sees twice the daily trade volume as its runner-up, Bitcoin. Zoom out, and Tether's daily trade volume makes up more than half of the daily trades placed in the crypto market as a whole. In fact, 3 of the top 10 cryptocurrencies ranked by market cap and daily trading volume are stablecoins: Tether, Binance USD, and USD Coin. Look at these metrics. It's plain to see that stablecoins are wildly popular in the crypto and blockchain community. In this video, we'll take a closer look at the current state of stablecoins, how they work, and what you should know about them as an informed investor. You should always do your own research, so we've provided links to pertinent information about stablecoins in the comments section below for further reading. So what are stablecoins? Stablecoins are crypto tokens whose value are pegged to a fiat currency, most commonly the United States dollar. Theoretically, the value of a stablecoin should remain on par with a dollar. So one stablecoin equals $1. And one stablecoin can be traded for something of a value equal to $1, or it can be traded 1-to-1 for fiat outright. Maintaining parity to the dollar has not been an easy task for any stablecoin. There can be fluctuations in the market price of a stablecoin, and market forces can raise or drop a stablecoin's price by a few cents hour by hour. Fluctuations in price beyond these few cents often signal that a stablecoin is about to or already has lost its peg. And when a stablecoin begins to float, it usually spells the end of that coin's success. The year 2014 saw the launch of the first 3 stablecoins: BitUSD, NuBits, and Tether, USDT. Only Tether has maintained its peg. Both BitUSD and NuBits lost their pegs by 2018, and they couldn't successfully regain parity thereafter, leaving BitUSD at a current price of around 80 cents and NuBits at around 30 cents to the dollar. Postmortems revealed these stablecoins had insufficient mechanisms for reigning in a stable price when the value of Bitcoin rose or fell drastically over a short period of time, especially when Bitcoin was used as a collateral reserve. Tether also dipped into the 90-cent zone for a short duration in the fall of 2018, but burning $500 million in USDT, 52% of its total supply at the time, raised the price back to $1. DAI, a crypto-backed stablecoin launched in 2017 by MakerDAO, also lost its peg, but the MakerDAO community voted to allow the recently launched USDC into its reserves in order to offset price fluctuations in Ether, DAI's sole collateral at the time. 2018 was a big year for stablecoin debuts. Early 2018 brought forth TrueUSD, TUSD, launched by Trust Token, and USD Coin USDC, launched by Circle, and both managed to slip through the cash relatively unscathed. Paxos's Pax and Gemini's GUSD also debuted in 2018, both touting approval from the New York Financial Services Authority as US regulated stablecoins subject to monthly audits. Some stablecoins never got the chance to lose their peg, as they ran into immediate failure due to regulatory interference. A 2018 project called Basis abandoned its quest to develop a stablecoin after raising $130 million in venture capital to do so. The reason? Their algorithmic design clashed with SEC regulations, and their stablecoin would have been classified as a security, making Basis a trade and taxation nightmare. Facebook famously failed to launch its own stablecoin, Libra, in 2019 after facing intense government scrutiny. However, Facebook's ambitions have not waned, and their stablecoin, rebranded as DM, is expected to enter a stablecoin-hungry market soon. Why use stablecoins? The crypto market is notoriously volatile and prone to price swings unheard of in other markets. In the first half of 2021, Bitcoin reached an all-time high of over $60,000 per BTC. That value more than halved to a figure of around $30,000 by summertime, and undoubtedly, the price of Bitcoin will rise and fall again. In the past, the only way to capture value from these price swings was to cash out of the blockchain and sell Bitcoin at a high for fiat currency. The other option would be trading Bitcoin for another crypto with prices that also move up and down, but this doesn't help pay the bills. With the advent of stablecoins, investors can exit positions on Bitcoin or any dynamically priced crypto by trading it for stablecoins of equal value. Investors can take profit by locking the value of their gains on the blockchain, and then they can decide what to do next. Stablecoin holders can reinvest their profits when crypto prices go down, off-ramp stablecoins into fiat currency, or participate in decentralized finance, often referred to as DeFi. The adoption of cryptocurrency is growing at a steady pace, and so is people's participation in DeFi. The demand for stablecoins has risen lockstep with the growth of DeFi, and the graphs charting the rise of total value locked in DeFi and the rise in the market capitalization of stablecoins over the last year are nearly identical. Stablecoins are an integral part of DeFi, and users wishing to find high yields on their holdings can do so by lending their stablecoins and receiving interest, or they can provide liquidity for various platforms and receive rewards in tokens that can be held or swapped back into more stablecoins. You can watch our video on DeFi to find out more about the world of decentralized finance. How stablecoins are backed and pegged. There are 5 ways stablecoins can be collateralized in order to maintain their peg. Stablecoins can be backed by fiat, other cryptos, seigniorage, algorithmically, commodities, or a combination of each approach. In this video, we'll talk about fiat, crypto, and algorithmically backed stablecoins. Fiat-backed stablecoins. The majority of stablecoins are fiat-backed. The top 3 stablecoins in circulation, according to market capitalization, include Tether, USDT, USD Coin, USDC, and Binance USD, BUSD. The companies issuing these stablecoins claim they're backed 1-to-1 by United States dollars in reserve or reserves in equivalent value. Whether a fiat-backed stablecoin is actually collateralized by cash has become a question on everyone's minds these days. Recently, the state of New York cast doubt over Tether's ability to match its collateral reserves to the total USDT in circulation. At the time of USDT's launch in 2014, Tether promised to back each of its tokens with cash, but this policy changed in 2019 to include other monetary instruments. The New York State Attorney General asserted that Tether failed to appropriately inform the public about this change, and Tether agreed to pay $18.5 million in fines. Recent audits have revealed that USDT is collateralized almost 50% by undisclosed commercial paper, or short-term loans usually taken by large corporations to meet short-term liability such as payroll or inventory. In May 2021, Tether revealed that its reserves include a sum shy of $30 billion in this form of short-term debt, making it the 17th largest holder of commercial paper in the world. As for cash on hand, Tether's May report revealed greenbacks made up only 2.9% of USDT's reserves, and the rest is made up of fiduciary deposits, secured loans, corporate bonds, funds, and precious metals. The drama surrounding the validity of USDT's reserves continues to unfold, but general sentiment has rested on the notion that Tether's massive lead in the stablecoin market has made it too big to fail. Crypto-backed stablecoins. Crypto-backed stablecoins are tokens that have been issued with over-collateralized deposits of digital assets. For example, if a user wants to mint a stablecoin backed by crypto, he or she needs to have deposit crypto at a rate of over 100% of the dollar value to be minted. And this over-collateralization can be closer to 200%, depending on the asset deposited. Let's look at the most widely used crypto-backed stablecoin, DAI, a token developed and minted by MakerDAO, one of the biggest and oldest players in the DeFi ecosystem. The DAO in MakerDAO stands for Decentralized Autonomous Organization. DAOs have no CEO, and they lack a hierarchical structure for leadership and decision making. Instead, users who hold MakerDAO's governance token, Maker, MKR, democratically vote on improvements and changes for the organization. This means that there is no centralized organization or company that controls DAI's fate, and this makes DAI a darling stablecoin in the world of decentralized applications. The first generation of DAI was originally collateralized solely by deposits of Ether, but nowadays DAI can be minted from deposits of a few other blue chip cryptos, including Chainlink and Uniswap. As mentioned before, the MakerDAO community voted to deepen DAI's crypto collateral with deposits of USDC. And in 2020, a vote greenlighted 8 additional digital assets, including the stablecoins GUSD, BUSD, TrueGBP, TrueAUD, and TrueCAD. Additionally, MakerDAO's governance token, Maker, plays a crucial role in pegging DIA to a consistent value. If the value of DAI minted exceeds the value of collateralized assets locked within the protocol, Maker tokens are minted to offset this missing value. Vice versa, if the stability of DAI's price is pressured downward by a surplus, DAI is used to buy back and burn Maker tokens, making DAI more scarce and therefore raising its value back to $1. In this way, the price of the Maker token remains fluid, rising and falling as it secures DAI's peg. Algorithmic stablecoins. Algorithmic stablecoins are backed by nothing more than coded rules and a dependence on market forces to maintain a stable price. Unfortunately, stablecoins backed by seigniorage, the term for this kind of peg, have historically failed across the board, and creating an algorithmic stablecoin that works, in the long run, is considered one of the holy grails of the crypto community. Algorithmic stablecoins are attractive for several reasons. They provide infinite liquidity for growing markets. They make fiat reserves unnecessary. They can separate the value of stablecoins from the fluctuations of an underlying asset such as the US dollar or Bitcoin. They are void of censorship and cannot be blocked by a central authority. Since it was launched by Terraform Labs in late 2020, the algorithmic stablecoin TerraUSD (UST) has risen to the number 5 spot for stablecoins ranked by market cap, with over $2 billion worth of UST in circulation. Built on the Terra blockchain, TerraUSD may be the most successful DeFi project to date that doesn't trace its origins to Ethereum. UST maintains its peg with the help of Luna, Terra's native governance token. When demand for UST rises and drives its price above $1, arbitrageurs can burn $1 of Luna to mint 1 UST and sell it for profit. This puts more UST into the market and pushes its price back to $1. When USD falls below $1, it can be burned to receive $1 equivalent in Luna, making UST more scarce and raising its price back to $1. The final verdict. Stablecoins have become an indispensable tool for crypto traders and those who participate in DeFi. They can be a store of value when markets rise or fall, and they can yield passive income if they're distributed wisely. There's no doubt that stablecoins are incredibly useful, and investors who familiarize themselves with stablecoins and build strategies for using them will be at an advantage over those who ignore this powerful but stable kind of crypto. On the other hand, one must remember that stablecoins are a relatively new financial instrument and not devoid of risk. Stablecoins lose their peg in tumultuous markets, and many have done so in the past. Furthermore, if allegations of minting stablecoins without the promised fiat to back it up are found to be true, then the entire crypto market will be shaken to the core. If the assets of any company that issue fiat-backed stablecoins are seized or frozen by the government, then say goodbye to your money. The recent meteoric rise in stablecoin popularity means that governments are hot on the trail. As we're producing this video, legislators and regulators are regularly debating the future of stablecoins, and their final decisions could mean an end to the heyday of cryptocurrencies pegged to the dollar. Thanks for tuning into this episode of WealthKode Blockchain Knowledge Series. Stay up to date by subscribing and following our pages for all future episodes. And feel free to comment if you'd like us to delve deeper into any of your favourite blockchains, cryptos, or digital assets in future videos. And don't forget to share this video with friends, family, and the online community to help them better understand this new asset class. I'll see you on the next episode.